Okay, so as we have a lot of things to cover today, let's get started. And as we go along, I'm sure we will have more attendees joining. So thank you everyone for being here today. So our topic for our webinar today is going to be around the key transfer pricing highlights of some of the key countries in Asia that I'm sure everyone should be aware of. There has been so many changes over the past year and even 6 months. I think these all changes is over the past 6 months that we thought that it was very useful to give some insights on what is happening in the region. And I am more happy and proud to say that this was an initiative that came from our staff more than us, and it's very good to see today new faces who are equally capable and very truly experts in transfer pricing and equally passionate as Poncho and myself. So before we kick on, let me just, for those who are new to our webinars, give a brief introduction of our firm. This is just a general disclaimer that this session is for information purposes only, and its copyrights belong to Transfer Pricing Solutions. So as you all know, we are a firm that specializes in providing consulting services in the area of transfer pricing to multinational companies. We pride ourselves from being practical, proactive, and cost-effective. We have offices in 3 countries. Our head office is located in Australia, our Singapore office, and Malaysian office. From the 3 countries, we cater to the whole region, hence the reason why we thought it was appropriate today to talk about Asia. Apart from that, we contribute to industry journals, apart from doing our consulting work, our webinars, education, and so on. So as you all know, those who are regular, we are very, very passionate about transfer pricing, and we love having everyone around here today. So brief introductions before we get into the topic. So for those who don't know me, my name is Adriana Calderon. I'm the director and technical lead for Asia, co-founder of Transfer Pricing Solutions Asia and Malaysia, with 15 years plus of experience in advising multinational companies in the area of international tax, transfer pricing, and domestic tax. And some of you may be familiar with Hon Chuan, who is our technical lead and guru based in Malaysia with over 10 years of experience in transfer pricing and always helping firms building up their transfer pricing practices. So we are lucky enough to have him already now for more than 5 years within our team. And 2 new faces, equally capable as well. Prasanna, who is one of our top transfer pricing specialists and consultant with more than 3 years of experience in the field with advising multinational companies also in the area of transfer pricing and helping them navigate the complex transfer pricing landscape. And we have RC also with us, who is another top transfer pricing specialist in our team with over 5 years of experience in transfer pricing, direct and indirect tax, and advising multinational entities in various industries, including construction, IT, logistics, and manufacturing. So with that, I'm going to pass the baton to Hon Chuan, who is going to start with some fun questions so we can hit up the ground for RC and Prasanna and make it a little bit fun and interactive today. So for those who wish to give an answer or have a clue on these questions, feel free to put the answer that you think in the chat box. The floor is yours, Hon Chuan.
All right, thanks, Adriana, for introduction. Now, I guess before we go through the updates, it's good to test our brain a bit, assess our knowledge, play the guess the country game, keep it going. So yeah, as Adriana has mentioned, you can put answers in your chat box. See what it's okay that you may not know the answer. That's fine. You can put a guess as well. So let's start with the first one. I am a country located in Asia. right? In March 2023, I just updated the list of countries that are involved in the automatic exchange of country report with me, and the list includes Israel, right? So for those that are not aware of country by country reporting as the automatic exchange, who am I in Asia? I'll give you like 30 seconds. All right. You muted, Adriana. So what do we have?
Nothing. I think people are still a bit intimidated, but it's okay. There is no right or wrong. You can go ahead.
Yeah, so the answer is actually Singapore. So basically, because I would imagine that country by country reporting is not that rampant. So the first answer is Singapore. And let's head to the second one. All right. Hello, mate. Well, that's a given. I've offered a simplified record keeping option for a total of 7 categories. Who am I?
Anyone who knows the answer can put it in the chat.
All right. So yeah, I guess the first one we've given the answer anyway. The answer is actually Australia. So Australia has quite a few options in relation to your safe harbor rates. So that's actually good to know in respect of Australia. And the third one is I am a country located in Middle East. 80% of my land area are deserts. I've recently decided to start taxing my people, which will take effect financially starting on or after 1st June 2023. There's a big one. So who am I?
Someone is raising their hand. You can put it in the chat. 2 people are raising their hands. You can put it in the chats unless you don't have chats. Let me just see. Allowed to talk. You can talk. The person who allowed them to talk.
Thankfully, it's like getting haywire.
Yeah.
Everyone's like, I know this. I'm seeing a friendly name as well.
Okay.
So yeah. Oh, chat apparently is disabled. Adriana, maybe you guys can put in under like question and answers.
You can put it in Q&A as well.
Yeah. Yeah. I think we have.
Okay. Everyone put it in the Q&A. In the Q&A now. Good.
Right. Yeah. I think a lot of people are actually know this answer by now. It's actually big news. Yes, it is UAE, and it is a big development in the UAE. It involves taxes, corporate taxes, transfer pricing as well. So, I mean, tax managers around the world will need to know about UAE. So that's good. Number 4 is, okay, a new one. I just proposed that the time limit for submitting the TP documentation is shortened to 10 days, right? I guess they're trying to beat Malaysia from the date of request. And the next thing is, I am known to be a symbol of true love. I mean, I didn't know about this previously, but now I know. So where am I?
In the Q&A, because the chat box is disabled.
that
Someone said
that was my answer before.
I think you can say it.
Yeah, all right. So number 4 is apparently India, right? I understand the person that said France. Well, you're partly correct on the symbol of love part, but yeah, doesn't jive with the 10 days, unfortunately. So yeah, so I've gone through this 4. I think it's good for us to actually understand, apart from TP, other tax development around the world as well, to increase our knowledge and awareness in terms of tax. So
let's continue then. Let me just clear this.
Yeah.
So we can continue.
All right, let's start going through, some of the updates, recent developments that we have seen so far. And Malaysia is one of the jurisdictions that has actually recently updated their transfer pricing rules. Tax Act, actually not the guidelines itself, it's actually the rules itself. And as you can see, there's a picture of a team here happily smiling, enjoying TP at the same time. So let's go ahead with Malaysia.
All right. Thank you, Hixie. So moving on to the first country of our presentation today, which is Malaysia. Malaysia is currently a hot topic among TP professionals in Malaysia due to its very, very recent updates that has been released by the Inland Revenue Board, whereby the TP Rules 2012 will be replaced with TP Rules 2023. And this would be effective year of assessment 2023 onwards. So there are a few items that we have to pay attention to, starting on with the transfer pricing documentation, additional disclosures on the M&E group info, business info, and cost contribution agreement. So in terms of M&E group info, the taxpayers must actually include information on the M&E group that are relevant to the taxpayers' business in Malaysia, which also includes additional details on M&E's key competitors, business models and strategies, industry and economic condition in which it operates. And for business info, the taxpayers are required to include information on the head of local department, where we have to state whether they are expats or non-expats and the number of employees in each department. And the next one will be CCA, Cost Contribution Agreement. TP guidelines have been incorporated with policies and procedures for adjusting the terms of CCA mechanism for managing responsibilities in relation to tempe of assets used in the CCA. And the second item will be disclosure of date of completion of TPD. So this disclosure of date of completion is actually important to ensure that the TP doc is actually contemporaneous. And previously, we do not have any requirement as such to insert the completion date. But with the current rulings, we are required to insert the date of completion, which shall be prior to due date for furnishing a return in the basis period for a year of assessment in which a controlled transaction is entered into. And moving on to the next slide. Yep, can you okay, move to the next slide? Okay, all right. So we have selection of best method. So previously we have preference to the traditional transactional method, but with the new ruling, the taxpayers are required to select the most appropriate method as per the OECD guidelines. And here comes the Director General's power to actually replace the selected TP method with another method that the Director General believes to be more appropriate. And the next item will be use of multiple year data, which is the weighted average. So previously, we are permitted to use the weighted average to compute the arm's length range. But with the new ruling, we are only permitted to assist in the selection of comparables and not for computation of the arm's length range. And one very important update, which will be a redefinition of arm's length range and median, where with the new rulings, the arm's length range has been defined as the 37.5 percentile to 62.5 percentile of the comparable data set, with the median being the midpoint of the arm's length range. And moving on to the next slide, we have adjustment to an arm's length price. Okay, so effective of year of assessment 2023, arm's length price shall be taken to be the median point if it falls outside the arm's length range. And the Director General has power to adjust the price of the controlled transaction to the median or any other point above median within the arm's length range where the uncontrolled transaction is the kind which has lesser degree of comparability, or any of the comparability defects cannot be quantified, identified, or adjusted. And also in the new rulings, the offsetting adjustment provision has been removed. And the last item will be indication of non-applicability of information, data, or documents. So with the new rulings, the taxpayers are actually required to indicate which are the required information, data, or document as prescribed in the TP rules that are not applicable. And to wrap up for the updates in Malaysia, I think TP practitioners should really pay attention to the latest development in order to assist the clients accordingly. And also, I'm happy to share that we TPS team will also be having a detailed webinar where we will cover specifically on the TP rules 2023 in July. So for those of you who are interested, please stay tuned. And I'll pass it to Hitzi for further comments on Malaysia. You're on mute, Hitzi.
All right. Yeah, sorry. Thanks, Prasanna, for the brief look into the Malaysian development. As you can see, unfortunately, it's more to it. It's not really favorable to taxpayers, and there are significant changes to TP. And we're looking at, now you have to put in the date of completion. So you can't do a wait and see approach and prepare at the end when you're actually being audited. And then arm's length range is narrowed down. It can be good or bad, because previously there's no mention of whether anything within the interquartile range is actually acceptable or not. Generally, median was the point. But now, if it's within the arm's length range, then you're considered okay. And more importantly, now that the DG is able to then adjust your price to the median, if you have not done any analysis, you have not prepared any TP documentation at all. So you're basically just letting them do whatever they want and then adjust your profitability upwards to the median based on benchmarking, the comparable benchmarking that they seem fit, right? So that's one of the big things that, to show the Malaysian taxpayers that you really need to look at your TP documentation. And yeah, unfortunately, they didn't include, any safe harbor, which I was waiting for. Hopefully, because now they have changed the TP rules, they're actually amending the TP guidelines. So stay tuned. Hopefully, the TP guidelines would have some other provisions in place to, ease the compliance burden for Malaysian taxpayers. All right, so that's Malaysia. Let's go to the next country, Singapore. Now, I think Singapore also equivalent, pretty prevalent in TP. But then let's see what's the new development in Singapore.
All right, so the most recent development in Singapore is regarding the CBCR notification. So prior to FY 2022, so the MNEs that is subject to CBCR filing obligation does not need to submit any notification to the IRAS regarding their filing obligation. But after FY 2022, they have to submit the notification to the IRAS informing about their filing obligation. And this notification should be submitted within 3 months from the end of the financial year. So which means for financial year ended 31st December 2022, you should submit by 31st March 2023. So this is actually to allow the reporting entity and the IRAS to confirm in advance regarding the RE obligations. So next, let's look at what are the things that needs to be submitted to the IRAS. And next slide. Right, so what should be included is the name and TRN of the ultimate parent entity, the financial reporting period, the declaration that the RE satisfies the requirement, personal particulars of the individual authorized by the RE as the contact person, which is this could be someone in your company that is responsible for transfer pricing matters in your entity. And the next one is the personal particulars of the individual authorized by the RE to file the notification. So this could be the details of your tax agent who is responsible to file the notification on behalf of your entity. So of course, there will be a penalty for non-compliance, which is a fine not exceeding 5,000. And if the payment is not made, it is imprisonment for not exceeding 6 months. For a continuing offense, it is a fine of not exceeding 100 per day. So before we move on to another country, so let us refresh a bit on the Singapore TP documentation requirements, which is so this TP documentation is mandatory for all taxpayers that is meet 2 conditions, which is first, gross revenue of more than Singapore dollar 10 million, or if you are required to prepare TPD for a previous year then the next financial year, you should prepare a TPD as well for the following period. So of course, there is also an assumption where your gross revenue is consistently below SGD 10 million. And for a specified transaction, such as sales and purchases, your services, and also loans, if it does not exceed the threshold, then you are exempted from preparing TPD documentation. Next, you have 3 documentation to prepare, which is first at the group level. It is similar to OECD master file. Second is at entity level. It is similar to OECD local file. And the third one is the CBCR reporting for certain taxpayers only. So when you should prepare the TP documentation is no later than the filing of the tax return, and the date is compulsory. So what Malaysia is proposed just now to include the date of completion into the documentation. So Singapore already has this in place, and this documentation should be submitted within 30 days upon request by the IRS.
Thank you, RC. I do have a commentary here, which is that typical question that we get asked is, oh, how often do we have to update the documentation in Singapore? And there is a misconception because there is some contradicting explanation in the e-tax guide, where one place says that you have to look at it every 3 years. But when you look at detail, actually the legislation, what it says is that you have to really review your documentation every year. It's just that the way in which you conduct that update, Singapore is kind of funny like that, because you can do something called a simplified update or a full update. Nevertheless, in Singapore by law, you actually do have to update every year, like any other country. It's just that there is avenues to do it simplified or full, but there is still a need for update. So that's something that is good to clarify to everyone. So typical misconception. Pass it on to you back, Monchern.
All right. Yeah. So I think I'll give you the misconception. It's not just Singapore. It's actually globally, where you're actually required to review annually, and then that 3 years, it's really more towards literally refreshing your benchmarking, your analysis that you have undertaken for your TP documentation. So if you can see from Singapore point of view, right, the Malaysian approach is getting rather similar. Now they have to have the documentation at the group level. That's for a full TP documentation, as well as having the date of completion. So yeah, and obviously equally important is the Singapore notification. A lot of taxpayers are not aware because of the previous ruling in place. So please make sure that those that has CBC obligation, please look at your notification and make sure that you notify the IRAS regarding the specific details of the CBC report.
Yeah, that's a really, really good point as well.
Mm-hmm. Okay, next we have Indonesia. Indonesia actually has quite a few important changes, developments that actually does have certain impact to TP. All right, let's go through Indonesia.
Yep. So moving on to Indonesia, when we say transfer pricing in Indonesia, it relates to the government regulation number 55 of 2022. And basically there are 6 updates that has been given by the government regulation, which will be effective 20 December 2022 onwards. And moving on to the next slide, the first item will be expanded scope of related party transaction. So prior to 20 December 2022, taxpayer had direct or indirect equity participation of a minimum of 25% in another taxpayer. The taxpayer controls another taxpayer, or 2 or more taxpayers are under the same control, either directly or indirectly, or there is a family relationship that has been established by blood or through a marriage. And with effective of 20 December 2022, control in special relationship covers the following, where one party controls another party, or one party is controlled by another party, 2 or more taxpayers are under the same control, the same people participate in managerial or operational decision making, the parties are commercially or financially known or claim to be in the same business group, or one party claims to have a special relationship with another party. And moving on to the second item, which is the next slide, it will be other methods, where prior to 20 December 2022, we have the 5 TP methods, which are CUP, resale price, cost plus, profit split, and TNMM. But with the new rulings, we have 3 additional methods that are comparable uncontrolled transaction method, tangible asset and intangible asset valuation, and business valuation. And the next item will be consecutive losses. So previously, taxpayers who are having losses consecutively for 3 years in a row will be targeted for an audit. But with the new rulings, taxpayers has to be in business for 5 years and they have to incur losses continuously for at least 3 out of those 5 years, and then they will be targeted for an audit. And the next one will be advanced pricing agreements, where the government regulation added to this framework of APA regulation the availability of multilateral APA, where previously only bilateral APA were possible. And this is basically to accommodate the TNMM method in APA negotiation, where the controlled transaction is with multiple related parties in different jurisdictions. And moving on to the next slide, we have the 5th item, which is the interest deduction rule. So with the new ruling effective 20 December 2022, the government regulation recognized earnings stripping rule to limit interest deduction. And according to OECD, the limit for ESR value can be set in the range of 10% to 30%. And the last one will be implementation of BEPS Pillar 1 and 2, where the government regulation actually laid the regulatory foundation to implement the BEPS Pillar 1 and 2 proposal, which will be regulated further via Ministry of Finance regulation. And as a conclusion for Indonesia, I think the taxpayers should really pay attention to all the updates released by the government regulation, especially when it comes to the new TP methods, where the TP practitioners should be aware of where and how exactly to apply those methods. So, yep, that's for Indonesia.
All right. Thanks, Prasanna. I think for Indonesia, really, we really need to look at that expansion of related party scope. It could potentially capture more entities into the transfer pricing purview as compared to before. So bear that in mind. And I think the consecutive losses part, targeted on consecutive losses, I think that's more to its providing leeway to taxpayers that may be a startup or new to the market, where you have to have a business in 5 years, then 3 consecutive losses, then you'll be targeted. Having said that, consecutive losses globally will be a trigger to tax authorities around the world. So bear in mind that if you do have entities with consecutive losses, really have to look at what is the commercial reason why the losses are there in the first place, right? A normal independent company would have gone out of business if they had gone through 3 years of consecutive losses, for example, right? And you have your interest deduction rules. I think a lot of jurisdictions now, they are leaning towards the earnings stripping rules, right? It's earning based instead of asset based. So that needs to be relooked at, especially the jurisdictions that are actually going from your thin cap rules to earning type stripping rules, so that you need to reassess your calculation into that. And lastly, of course, the interesting part for BEPS Pillar 1 and 2, a lot of jurisdictions are doing Pillar 2. Pillar 1 is the one that's under construction. Even OECD is trying to draft something constructive for Pillar 1. So interesting that they're actually putting in Pillar 1 as well. So, all right, that's for Indonesia. Now let's
Before you go to the question,
right.
I do have one more commentary here, which is
Sure.
that Indonesia has this rule that some of the documentation thresholds do not apply when the country is having transactions with countries with a lower tax. So, for example, Indonesia with Singapore, Indonesia with Hong Kong, Indonesia with UAE. So that's something to be very mindful of, because what that means is that even if you have a small transaction with Singapore, with Hong Kong, with Indonesia, it makes you automatically required to prepare TP documentation because of the lower tax rule. So that's something to keep in mind, because Indonesia is a big trading partner of Singapore, I'm sure UAE at some stage, and Hong Kong as well. So that's something to keep in mind, that as long as you have transactions with Singapore or Hong Kong or UAE, you will be required to prepare documentation very early, because there is no value threshold for that.
Mm.
Okay,
Yep.
pass it back to you.
All right, so I guess we have to guess the country game round 2. All right, so number 5 would be my individual income tax rate is 32%. Apparently the 3rd highest in the entire ASEAN region, and my island is known as the Palawan Island. Where am I?
Feel free to write in the Q&A.
Ooh. Yeah, I know you know the answer. No.
But someone already got it.
Yep. Okay. For number 5 is the Philippines. So their income tax rate is 32%. Now, for other ASEAN countries, the top 1 and top 2 apparently is Thailand, which is 35%, as well as Vietnam as well, 35%. So that's food for thought there. Number 6, I recently reintroduced the special voluntary disclosure program. Right, starts on 6th of June 2023 to 31st of May 2024 for my taxpayers, and this time apparently with full penalty waiver, but that is yet to see whether we have that full penalty waiver or not.
So who am I?
Yeah. Who am I? This was very recent.
Okay.
Yeah. Okay, so number 6 is Malaysia, right? So Malaysia recently introduced this special voluntary disclosure program to actually, look at taxpayers that wanted to voluntarily disclose their position, responsible position, as well as the tax, with the view of having a full penalty waiver. Disclaimer is that there are still certain uncertainty, even though the program has been out. There are a lot of definitions that has yet to be answered, so we really need to make sure that we look into that in detail. Okay, next is number 7, which is this is a tricky one. I've introduced 3 additional TP methods from December 2022. I'm popular for my beautiful beaches, and swing is my famous tourist attraction. So for those that have sort of listened to the earlier session, you will know this answer.
Oh,
Yay.
someone guessed it.
All right, so number 7 is Indonesia. So they have indeed introduced that 3 transfer pricing methods. It's sometimes not, it has been around, but they have make it clear on the definition of those 3 methods. So it's good to have additional methods in place for your analysis. All right, now we've gone to the guess the country game. Let's look at the next country.
Okay.
Which, yeah, lag.
I have to clear the drawing.
All right. Okay, you can see now. So there we are again in Australia. Yeah, so our headquarters is actually in Australia. So our team actually went to Australia at a team building exercise. So let's start with the Australian development and see what we are looking at. Arzi.
All right. So for Australia, the most recent developments is on the new earning-based interest limitation, which is based on the OECD recommended approach. This is actually to replace the existing asset-based cap rules for general class investors. So under these proposed changes, the TP rules will be able to modify the content of that associated with cross-border financing arrangements. And this amendment is proposed to commence for income years on or after 1st July 2023, which is very soon, but this is still at proposal stage. We have not heard any approval for this yet, so we should wait for this. So before we moving on to the new rules, let us recap what is thin cap rules first. Right, on the next slide. Right, so these thin cap rules will affect both Australian and foreign entities that have multinational investments, but the taxpayers will not be affected by the thin cap rules if you satisfy one of the following tests. So the first one is if you are an Australian resident entity that is not an inward investing entity, not an outward investing entity. Second, you are a foreign entity that has no investments such as assets or PE in Australia. Third, if your entity meet any of the 3 threshold tests. So the 3 threshold tests are, the first one, your debt deductions together with those of any associated entities is less than 2 million or less for the income year. Then the second one is your entity is an outward investing entity that is not also foreign control and you meet the assets threshold test. And the third one, your entity is a special purpose entity established to meet certain risks. Right, moving on to next slide. Right, so if your entity is subject to these thin cap rules, then your entity debt deductions are limited to the extent that its adjusted average debt exceeds a maximum allowable debt amount, whichever is lower. So this amount can be calculated by applying 3 tests. The first one is safe harbor test. This is the most commonly used. Second one is the worldwide gearing test. Third one is arm's length debt test. So this restriction is placed on current TP rules to limit application with regards to an entity level of debt. So if it is found out that you obtain a TP benefit in respect of debt deductions, then the interest rate is allowed to be adjusted to an arm's length interest rate. But it must be applied to the debt interest actually issued. So then the thin cap rules may further deny debt deduction if the actual debt amount exceeds the maximum allowable amount. So next, let's look at the new proposed rules. Right, so the exposure draft actually introduced 3 new tests for general class investors, which is the first one is the fixed ratio test. It's 30% of the tax EBITDA. This is actually to replace the safe harbor test. The second one is group ratio test. It is to replace the worldwide gearing test. And the third one is the external third party debt test. So if it's determined that this level of debt or the interest rate is inconsistent with the arm's length, so similar to the current rules, so the TP rules will apply to deny all or part of the debt deductions. But there's no one advantage. If you choose to apply this fixed ratio test, then these new rules actually allow you to carry forward your denied interest deduction for 15 years, subject to taxpayers satisfying the continuity of ownership test. So I have an example to clarify, to show you what's the difference between the current rules and the new rules. So let's assume that this Australian company has a total debt of 400 million with its international related parties with 10% interest rate. So the interest amount is 40 million, which is 10% of 400 million debt. And based on the current rules, your maximum allowable debt is 400 million. So we assume that they apply the safe harbor test. And under new rules, under the FRT, then 30% of your tax debt is 40 million. So now let's say this 10% and 400 million of that amount is not at arm's length. So then we adjust it to 8% of interest rate and 300 of arm's length debt amount. So under the current rules, the debt deduction is calculated by 8% times with the original debt amount, which is 400. But under the new rules, your debt deduction is calculated with 8% times with the arm's length debt amount, which is 300 million. So now if we can see, the deduction denied under the current rules is 8 million, but under the new rule, it's double the amount, which is 60 million. So this is actually a big changes, and this means that your profit before tax will increase and your tax to be paid also will be increased. But the good news is if you apply the FRT under the new rules, then the 16 million will be allowed to carry forward for 15 years. So yeah, that's it for Australia. Back to you.
All right. Thanks, RZ. I think it's really good to have this example in place because then it sort of not just illustrates Australia's point of view in terms of changing from tin cap rules to earnings stripping rules based earnings based. So if you look at this example, right, basically there is an impact, right? So you then need to reassess, not just in Australia, but those jurisdictions that are actually changing to the earnings stripping rules, aligning with the OECD guidelines, then we really need to reassess whether there are any additional deduction to be denied in the new income year. So it's a good illustration, and it would affect most of the asset-based testing for intercompany loans or interest deduction. So bear that in mind. All right. So next, we have lovely Philippines. I love the island, by the way. So for Philippines, I think that's not much changes, but then there's one thing that's changed. So maybe you can go through that, Prasanna.
Sure, Hetzi. So as mentioned by Hexi, there are not much changes and the updated rules are at 2022. But during 3rd December 2020, effective from, so we have the Philippine Bureau of Internal Revenue issued revenue regulation to provide guidelines and procedures for the submission of new and simplified BIR form, which is also known as the RPT form. And the following taxpayers are actually required to file and submit the new RPT form together with the annual income tax return. Large taxpayers, taxpayers with tax incentive, taxpayers reporting net losses for the current taxable year, and the immediately preceding 2 consecutive taxable years and a related party. And in terms of the updated rules, there is a shift of focus towards MAP, mutual agreement procedures, where MAP can actually help in relieving double taxation either fully or partially. So that's for the update for Philippines. Back to you, Betsy.
Thanks, Prasanna. I think it's good to know that a lot of jurisdictions now, especially for developing countries, where previously they do not really have RPT forms in place. Now, a lot of countries have imposed or introduced these new RPT forms as a way to. Oops, I think the Ariana photo. Yeah. Let me share the screen then. As a way to look at a trigger point for tax authorities to reassess your transfer pricing position based on your the details that you need to declare. So when you have these RPT forms in place, it more or less means that you need to have the TP documentation in place to actually fill that RPT form in. So hold on. Technical difficulty. All right. Yeah, you can be sharing. Hold on, let me your host again. Yes, I've gone. All right, thanks, Adriana. So I've gone through Philippines. Let's look at the next section, which is India. I think that it's more or less a proposed one, but it's good to look at what they're proposing for in India. Adriana, could you switch to the next slide, please, to India?
Yes, sure.
Okay. Yeah, right. So let's start with India.
All right. So for India, so as mentioned, there's not much changes in India, but recently in their union budget for 2023 to 2024, there's actually 2 key points on transfer pricing that is proposed, which is the first one is a time limit for submitting TP documentation. So previously, similar to Singapore and also Malaysia, you need to submit the TP documentation within 30 days from the date of request. But now Malaysia is changing to 14 days. And now India is proposed to change to 10 days from the date of request, which is a big change. And it's highly impossible for us to prepare TP documentation within 10 days from the date of request, actually. And the second one is the exclusion from the limitation on interest deductibility. So currently, this exclusion only applies to banking or insurance business, but now it's proposed to extend this exclusion to include non-banking financial companies. So non-banking financial companies could include those investment companies, visit-based company, and etc. So that's all the proposed changes in India regarding transfer pricing. Back to you, Macy.
Thanks, RZ. Though two TP proposed changes, but very significant change. To be honest, we have 10 days. That's as compared to Malaysia is 14 days. They have 10 days now. I can foresee other jurisdictions will be following this this trend to reduce the days to provide the TP documentation, as well as looking at expansion to the interest deductibility. That will affect a lot of taxpayers in that region. So next, the last one is, we wanted to sort of look at UAE as well, because it's a big thing, and I'm sure you guys are all aware of what's changing UAE. It's good to actually refresh this and see what's happening in UAE. I'll pass you on to you, Prasanna.
Yep. So UAE is also a very much hot topic now, because previously there are no TP regulation in place in UAE prior to 2023, and the new regulation will be effective 1st June 2023. So the Federal Decree Law number 47 was actually released by the Ministry of Finance on the City Law. And City Law is basically a law that will introduce the TP regime, which is in line with the OECD. And the Ministry of Finance has issued the ministerial division on what are the requirements to actually maintain the TP documentation. And the decision specify instances where taxpayers must maintain TP doc, specifically a master file and a local file, including if they have revenues in a relevant tax period of at least AED 200 million, or they are part of a M&E group with a total consolidated group revenue of at least AED 3.15 billion in the relevant tax period. So moving on to the next slide, who must prepare TP documentation? So all UAE taxpayers, both foreign-owned enterprises and domestically owned enterprises that enters into domestic between mainland and free zone entities and cross-border transaction with its related parties are actually required to prepare a TP documentation. And qualifying free zone person is eligible to benefit from a 0% corporate tax rate on its qualifying income. However, they are still required to prepare a TPD. So qualifying free zone person are actually defined as a company or branch registered in a free zone that maintain adequate substance in the UAE, derives qualifying income, satisfy all the TP requirements, and also meet other conditions prescribed through ministerial division. And as per the OECD TP guideline, the documentation includes master file, local file, and country by country reporting. So that's the update for UAE. Back to you, Betsy.
All right, thanks, Prasanna. As you can see, really big changes in UAE. UAE is under the spotlight right now to see how it will pan out with all the introduction to the tax world. And lastly, I just want to wrap this up saying that, we have gone through all these updates and we do it internally. We just decided to do it externally just to share with you guys the knowledge. And we do love transfer pricing, and we don't confine ourselves in just the jurisdictions where our offices are, right? We actually do provide services to other jurisdictions out there, say almost globally. So we do have transfer pricing services provided in all jurisdictions.
Thank you, John. So now we can open the floor for questions. So as you were saying, we can help with global documentation, global master file, local documentation, regional benchmarking, global benchmarking, contracts, so you name it. Before we open for questions, as we always say, we don't ask for compensation, but we do ask for likes. So please go to our YouTube channel, like us there, like us in our social media channels, and engage with our content. We have a few things coming up. So we have some sessions with the Singapore accredited tax professional, which is called the bear side of transfer pricing, which is a Q&A session. We have 6th of July, managing intragroup financing in Asia. We have one more, which we just set the date today, which is 13th of July. We will be doing the webinar that will focus on Malaysia new transfer pricing guidance and the changes. And we have another webinar coming on the 27th of July, which is one of our signature sessions, which is called Managing Intragroup Services in Malaysia. So a lot to do in July, but we'd love everyone to attend. Let's just go then with the questions. Okay, so there is one question. What kind of transactions are considered intragroup loans? Payments on behalf, outstanding service fee carried forward for the following year. Could this be considered a loan?
Well, we do have the managing intragroup financing, but the best way to look at the definition of intragroup loans is you need to look at the debt versus equity definition in that particular jurisdiction. More or less, it will be the same, but you need to look at the definition of that and look at whether your transaction, the nature of transaction, the purpose, does it fall under the definition of the debt or not, right? You have all these payment on behalf. It may or may not, right? So it really depends, because payment on behalf can translate it back to loans, for example.
Thank you, Juan Chuan. So we have another done. So we have another question for UAE. The new TP laws are to be effective for which tax period onwards? FY 2023 or FY 2024?
Well, the specific date is 1st June 2023. So
Yes.
it really depends on your financial year and your company's financial year. And if it's after 1st June 2023, that will be effective from that date.
Yeah, so for example, it would cover financial year in 30. So if I am March year end, my March 2023 wouldn't be there because it's before 30th of June 2023. So my first year, so in other words, the ones who have their year end before 30th of June 23, they will effectively be under the radar in 24, right? I think that's how it works. So it's 30th of June 2023. There is another question which is curious on the timeline of TP audits in Malaysia. Do they start off by asking for TP doc? How long do they take to review it and come back to the taxpayer usually?
I think it's case by case. I can't really say on the timeline. It really depends on the complexity of your the company itself. But generally, it used to be they do it through a tax audit, and they actually send in an MME form, and then they may ask for a TP audit. Now, they will specifically ask for a transfer pricing documentation. It depends on whether sometimes they'll go to a review first, then do a desk audit, and then once on the desk audit and they still find it not reasonable, the documents, the work papers, all the documents provided is not satisfactory, then you do a site audit and make sure you go through your interview process with the personnel to ensure that in substance you are what you are as explained or documented into your TP documentation. And the timeline really depends on, it's like an ongoing process. So there's no one timeline per se.
Thank you, Juan Chuan. So there is another question, which is where we share our slides. We don't, but we do share the recording. There is another interesting question that is a very interesting one. You have to take your crystal ball out.
Yeah.
Do you all foresee that other countries will tighten the arm's length requirement to 37.5 to 62.5, follow Malaysia and not the IQR?
You see, with this range, right, it's actually, Malaysia is not the first one. There are already other jurisdictions that actually have this range in place. And it really depends, because unless really OECD going to start doing this range, but I don't foresee countries actually following this because it's more towards government preference. I think. What's your take on this, Adriana?
There is already Vietnam, who also narrowed the IQR. There is also India, who narrowed the IQR long time ago. There is also China, who has some wording around similar to Malaysia, whereby if you don't fall within the range, kind of the government has the option to look at the median. So that wording is there. I think the QR is still being followed. The interquartile range is still being followed by Thailand, Singapore, Indonesia, Philippines. Am I missing any country?
Well, developed countries, don't think they have any narrowed range.
Yeah, so I think the exceptions are really India. The exceptions
China
are
and Malaysia. No?
India, Malaysia, Vietnam, and China, who has some wording of what is there. In the Americas, I haven't seen this trend, neither in Europe. So it's quite an Asia trend. So we'll see if everyone wants to follow the Asia trend on this. I guess I don't oppose necessarily to narrow the range, and hear me out here, because I know maybe everyone is going to jump to me saying, what are you talking about? The reason I don't oppose to some more clear guidance on the range is because it can be quite gray area. So at least if there is some very clear language around what do we expect within the range that the taxpayer falls into, at least there is some expectation, and people already know that at the end of the day, what the tax authority wants is narrow ranges. That's my take on it. That you cannot go, I remember, and I can say this because I remember someone once telling me, oh, then maybe it's better that you just do a range based on 100 companies. So you literally include every comparable in your country. So the tax authority can never go, you're already presenting all possible comparables. So then the tax authority cannot come with any unknown comparables. But then on the flip side, what I was telling that person was like, when you do that, then you're going to have a range that is like from 1 to 50. So any point in the range. So I think my point here is that we, and I don't know if you agree with me on this and the rest, that we always have a bit of hesitation on very narrow ranges in general, because if it's very narrow, it's kind of like you're saying, well, any point in the range is valid. In my opinion, I feel a lot more professionally comfortable when we have a narrow range that is used as basis to set up the price. But that's my professional preference.
Yeah, I agree with you on the narrow range, but I always love looking at narrow ranges. Means that whatever you chose is more or less comparable.
Yeah. So there is another couple of questions. We have like 2 minutes for a couple of questions. So in Singapore, should the Singapore subsidiary company?
Adriana, I can't hear you. Yeah. Oh.
Should the Singapore subsidiary company of multinational enterprise group prepare CBCR? No. The answer is no. The CBCR applies only to ultimate parent companies located in Singapore. It's one of those jurisdictions that do not have this subrogated clause associated with CBCR. And one more, Australian company lend money to Belgian subsidiaries to fund the acquisition of other business assets only rather than acquiring the entire at zero rate. Are there any TP implications? Oh, this is looking more like consulting. But
there are implications, yes.
Yeah, there are TP implications.
Yes.
Well,
100%.
okay. All right. So I think with that, so we're pretty much done. Thank you everyone for joining us today. Thank you, RC. Thank you, Prasanna. I hope you enjoyed this forum as much as we did. So you come again to present. You did a fabulous job, I have to say. So you should be very proud of yourselves. Excellent job. So these
Thanks.
are our details. And if you want to reach to us and have a discussion about your transfer pricing in Asia, this fabulous team will always be here to help you. Thank you.
Thanks.
Thank you.
Thanks, Steve. Bye.